Welcome everyone to the Kimberlite Perforating and Completion Fluids webinar. My name is David Batt, President of Kimberlite Research, and I'm glad you're able to join us here today. This is our 13th Kimberlite webinar series. Our past webinars have included reviews of many of the oil field products and services most commonly used in the industry, such as drilling services, artificial lift, cementing services, surface wellheads, subsea, pipeline integrity, inline inspection, and many others. We've also taken deep dives into the competitive landscape of the Permian Basin, as well as compared the performances of the big three oilfield service companies, Schlumberger, Halliburton, and Baker Hughes. And just last month, we reviewed the hydraulic fracturing market with updates on ESG, dual fuel versus electric, simultaneous hydraulic fracturing, and other technologies, in addition to assessing the changing competitive landscape with Liberty Oilfield Services having acquired the Schlumberger hydraulic fracturing assets in the recent acquisition of Alamo by NexTier. Let us know if you or your colleagues would need access to any of these prior webinars, and we'll be glad to send you a link. Just give us an email or a chat message today. Today, we'll be reviewing the perforating and completion fluids markets, including updates on perforating guns and shaped charges, as well as an overview on the competitive landscape of how the service suppliers for all these services, how they stack up in terms of performance and service across various geographies and customer groups. Feel free to submit questions during the presentation today, and we'll try to address your questions as we go through the presentation. For those of you that are not familiar with Kimberlite Research, I'll provide a brief background and then dive right into the perforating and the completion fluids markets review. At Kimberlite Research each year, we collect voice of customer feedback from about 3,000 users of oilfield services globally. Some of you on the webinar here today may have participated in one of our prior industry studies. And for that, I say thank you. These webinars are really intended for the oil and gas operators as a professional courtesy, and thank you for your participation in these industry reports. Our research is about 50% international and about 50% North America. Through these 3,000 one-on-one personal phone interviews each year, we prepare a series of reports that address the formation evaluation market, drilling, completion, production, subsea, and pipeline, including pipeline integrity services. Today, we'll be covering the reports dealing with perforating and completion fluids. The findings and the analysis that I'll be sharing with you today are based on personal interviews with 290 completion engineers and managers worldwide, and these interviews were conducted in July, August, and September of this year, representing over 180 different oil and gas operating companies. The data set that I'll be presenting with you today is rich and multidimensional. And in this exhibit, we will cross-plot supplier performance on the x-axis versus pricing strategy or pricing competitiveness on the y-axis. So before diving into today's presentation, I would like to just kind of explain these four quadrants on this value map, as we call it, just to make sure that you're familiar with how to interpret this graph. So this value map is a visual picture depicting the competitive landscape of each supplier. The top right-hand quadrant is the premium offering quadrant, where suppliers cost more than industry norm, but they're worth it because they deliver better than industry average performance and results. The bottom right-hand quadrant is the value advantage quadrant. Suppliers in this quadrant are viewed as performing better than industry average and other competitors and positioned to grow market share. The bottom left-hand quadrant is the discount quadrant, and even though suppliers underperform, they offset their performance shortcomings with pricing accommodations, so effectively you get what you pay for. In the top left-hand quadrant is the disadvantaged quadrant. Any suppliers in this top left-hand quadrant really need to put in place a recovery plan to improve performance, or they're probably at risk of customer defection and loss of market share. So with that, let's go ahead and dive in. I think maybe one of the first things we want to take a look at is just kind of the overall health of the industry. When we track the diffusion index, and as you know, 50 is no change in economic activity, and above 50 is expansion, and below 50 is contraction. You can see how the perforating market went into deep contraction in 2020 as a result of the demand destruction due to coronavirus and also the oil price war between Saudi and Russia. But you can also see how the diffusion index has sharply rebounded, and all the markets for perforating are back into expansion mode. When you compare the perforating market to that of the drilling services market in blue, you can see that drilling services is by far the most volatile of oil field services, with really sharp contraction in 2020, and was actually, coming down into contraction mode even before COVID hit. And the next most volatile is hydraulic fracturing and perforating. But the production solutions and production services market, say artificial lift and production chemicals, is the least volatile of these services. We just published the artificial lift and production chemicals report this week and last week, and we'll be having a webinar for that in the month of November for those interested in those product segments. If you kind of just look ahead into 2022, the oil and gas operators are projecting to drill about 12, 13, 14% more wells in 2022 versus 2021 in most geographic regions, with the exception of Canada, that is projecting a little bit higher increase in the number of wells to be drilled in 22 versus 21. But overall, the backdrop looks very healthy for what many believe, and us included here at Kimberlite, will be a multi-year capital investment cycle for 2022, 23, and 2024. On the perforating report, when we asked the oil and gas operators, where they'd like to see improvements in perforating technology, this is an open-ended question, and the operators are free to speak whatever is most concerning to them. We read through those 200 plus verbatim comments, and what we see is some distinctions between the various geographies. The North America land operators tend to be talking more about looking for improvements in reliability of their tools with fewer misfires of the guns, followed by improvements in isolation and oriented perforating and even real-time data acquisition. The international land operators tend to talk more about modeling and penetration. If we take a little bit of a deeper dive in North America land and focus on the all-important Permian Basin, we'll find that reliability of the tools and fewer misfires is really a paramount concern and really led the comments for about a third of the Permian Basin operators surveyed, followed by, you see the importance for improvements with oriented perforating, automation, and such. Whereas if you go offshore, most of the commentary from the oil and gas operators surveyed and that we interviewed, we're talking about improvements in deeper penetration. So clearly there's some differences in the technology needs between the international operators, the offshore operators, and the U.S. land operators. Now, if we kind of dive into the U.S. land market a little bit, there's been some changing dynamics in the behavior of the operators with respect to the use of perforating guns and shaped charges. If you focus on the right-hand side of the screen, and we'll focus on the Permian Basin, what we're noticing is that the operators are using more guns per stage. It's just that these guns are much smaller and shorter than historical, and they're also using fewer shots per gun. So even though the guns per stage in the Permian Basin increased by 14%, the number of average shots per gun went down a corresponding 14%, down to almost 3 shots per gun. So we're using more guns. They're just smaller and shorter with fewer shots per gun. So if you kind of look at this in total, you'll see that the number of guns per well is going up, but the number of shots per well is not necessarily going up at a corresponding level. So guns per stage may be going up 14%, but the total shots per well is only going up 5%. And that's a function of the operators in many cases trying to orient their guns to try to get equal hole size to help improve completion stimulation results. In terms of preferences, what we find is that 79%, almost 8 out of 10 North America land operators prefer the integrated gun system over the conventional gun system. These preferences haven't yet made it across to the international markets, But you can see that the preference for integrated gun systems is continuing to climb from 10% in 2019 up to 17% in 2021. The preferences for the gun systems, for the integrated gun systems, again, this is another open-ended question. The operators are fairly uniformly telling us that they really do like the improved reliability and improved safety, which are really key features, along with improved operational efficiency and speed and ease of use. Among those operators that prefer conventional gun systems, most typically the reasons most commonly cited why they continue to use them is, they view it as being lower priced, and it's just something that they're familiar with. Looking ahead into the future, you can see about 42% of the North America land operators expect the use of integrated gun systems to continue to increase, and about 13% of international and 20% of offshore operators expect the use of integrated gun systems to increase. So while the use of integrated gun systems are predominantly North America centric, it is expected that the use of integrated gun systems will continue to grow both internationally and offshore, albeit at a much slower adoption rate than what we've seen in U.S. land in North America. The size of the perforating gun and shaped charge market has certainly changed as a result of the 2020 downturn, but I think many people were surprised in 2019 that the market was a $1.3 billion market, but more importantly that the integrated gun systems comprised the bulk of it at $900 million roughly. Naturally, the entire market decreased in 2020 as a result of the downturn. But when we come back into 2021 with the sharp rebound in the number of wells that we've seen drilled in 21 versus 20, the market's rebounded not quite to pre-COVID levels, to $1 billion, but you can see that the integrated gun systems have almost rebounded to pre-COVID levels at nearly $900 million, and they're comprising 86% of the market in North America land, which is higher than the 68% of the market for which they comprised back in 2019. So you can see how sharply the integrated gun systems in North America land have rebounded in terms of comprising their share of the overall market, but the conventional guns and conventional shaped charges simply have not rebounded and are not expected to do so. For those of the oil and gas operators who have preferences for their shaped charges and guns that they use, what we find is in North America land, the operators tend to have a preference for Owens and Hunting along with geodynamics. Owens and Hunting both have strong reputations in the industry with an established track record of shaped charge performance, and they're viewed as being reliable and reasonably priced. Geodynamics is widely known and associated for having differentiated technology and performance, and you can see that their preference in the market has been growing amongst operators. DynaEnergetics is also known for performance, but their shaped charges are most commonly associated with the integration of their gun systems. When you look internationally and offshore, Schlumberger is by far the preferred leader for shaped charges, even though they may or may not manufacture their shaped charges. They are the supplier with whom the operators go to, and Schlumberger provides the shaped charges, and they're associated for having this leadership, followed second by Halliburton. When we turn to perforating guns, what we find is Hunting and DynaEnergetics are really the leaders in integrated perforating guns and perforating gun systems. Both, Hunting has a strong reputation in the industry with a strong track record of performance, but DynaEnergetics is also known for performance and really an early leader in the development of the integrated guns. Geodynamics' presence has been growing and preference in the market's been growing. Owens has been kind of relatively flat. I failed to mention, but I'll back up one slide, that if you look at Owens' preference for shaped charges, though, it does experience some decline, which tends to correspond with some of their financial results and lack of market growth overall. One thing to note in the North America land market for perforating guns, however, is that many of the suppliers, be it NexTier or Liberty, who's acquired the Schlumberger wireline perforating assets, or even GR Energy, are beginning to develop their own gun systems. So we'll continue to track moving forward, how the awareness of these perforating service suppliers as they start to go to market with their own assembled guns, if you will, how well that begins to capture the brand awareness and preference amongst the operators. Internationally, again, Schlumberger leads as the preferred gun supplier, followed by Halliburton and then Baker Hughes. In terms of who's really calling the shots in the selection of guns and shaped charges, what we find is that the North American land operators still heavily rely upon the service company to provide their expertise in selection of guns and shaped charges to be used. About a third of the North American land operators tend to take a more proactive stance in setting specifications and preferences. The Gulf of Mexico operators are by far the most proactive. And again, internationally and internationally offshore, you see that the service companies play a fairly significant role in helping to guide and shape the selection of the perforating guns and shaped charges that are being used for the jobs. With this, we're going to transition and change gears, and we'll dive into the wireline perforating market first, then the tubing conveyed market second, and then we'll go into the completion fluids market third. When we interview the oil and gas operators in North America land, and we ask them, who have you used for wireline perforating? And again, this is principally focused on pump down perforating. We have an entire another report for well interventions cased hole work, and that probably will be updated in about another year. But this is principally pump down perforating with some other cased hole perforating in it. But we find that the market is very, very fragmented. There are 41 different wireline perforating suppliers cited as being used in 2021. Granted, that's down from 51 suppliers in 2019. So the market is clearly consolidating, but it's still overly fragmented in supply. The oil and gas operators are also consolidating the use of wireline perforating suppliers down from 2 suppliers on average down to about 1.5. So the oil and gas operators are consolidating their use of suppliers. In terms of the perforating suppliers that have the deepest market penetration, you see Liberty and GR Energy kind of leading the top along with Halliburton. So these are the top 3 suppliers with the deepest market penetration. Obviously, again, Liberty acquired the Schlumberger assets, although that's a new name that folks may or may not recognize. Next tier and Perfex and 9 Energy follow, along with Tier 1 and so forth. If you go into the Permian Basin, which is a very important basin, we see contraction of 30 suppliers being cited as used in the 2020 perforating report, down to 20 suppliers in the 21 perforating report. And you can see that the average Permian Basin operator is fairly consistent over the last couple of years of using nearly 2 suppliers at 1.70 to meet their perforating requirements. GR Energy is the leader in market penetration, and they also lead in market share in the Permian Basin, followed by next tier, Liberty, Halliburton, Perfex, Dynasty, and Silvertip. You can see Reach and 9 Energy, Reliable, Allied, and also follow in kind of mid-single digit market penetrations. But again, it's a very fragmented market with 20 different suppliers. If you look at the market share in North America land, you'll find that Liberty and GR Energy lead, but if you go to the Permian Basin, you'll see that GR Energy is the market share leader in the Permian Basin. When we ask the oil and gas operators to rate the performance of the suppliers with whom they're using on a scale of 1 to 10, with 10 being excellent performance and 1 being very poor performance, what we find is from the oil and gas operator's perspective is that there's a wide degree of variance in the performance of the various suppliers, that they're not performing homogeneously the same. So if you're an oil company and you're trying to select best value or best performing perforating supplier, you really need to do your due diligence, because based on thousands and thousands of supplier performance ratings over the last 5 years, when we conducted the survey in 17, 18, 19, 20, and 21, what we find is that these wireline perforating suppliers are not performing homogeneously the same year in and year out. We see some variability. I mean, certainly some, like Halliburton here, are consistently receiving customer review ratings on a scale of 1 to 10 that are below industry average. So Halliburton is consistently underperforming in the North America land market. But others, like here, next year, you can see that their performance ratings tend to track industry average. Whereas if you come up here and you look above here, you've got companies like Perfex, whose ratings have traditionally been better than industry average, along with Pioneer, who's recently acquired by Patterson, UTI. Their ratings, consistently higher than industry average for many of the years. But every now and then you'll start to see some declines and changes that take place. And so as a user of the services, as an oil and gas operator, being able to effectively benchmark and evaluate suppliers is important in order to be able to assess where best value will be derived from. And we see quite a bit of variability in the performance of these suppliers based on the customer reviews from the oil and gas operators for responsiveness to needs, equipment quality and reliability, competency of the field service personnel, even though we do see a little bit of convergence here taking place in 21, technical support, availability, and even pricing competitiveness. So when we translate this to the value map that I shared with you, you can see that certain suppliers like GR Energy plot in the top right-hand quadrant as a premium-based supplier, whereas Liberty, who acquired the Schlumberger assets, and Halliburton are plotting in more of a competitively vulnerable position. Many of the small to mid-tier suppliers plot in the value advantage quadrant. Nine Energy is more of a discount provider. So if you kind of drill down into the Permian Basin, given the significance and the size of the basin, well, some of the major changes that we see is that Silvertip remains as a value advantage supplier. GR Energy, who's the market share leader, is very solidly positioned as the premium supplier. This is the quadrant that you would expect the Liberty or Halliburton to occupy, but it's being occupied by GR Energy. Knowledge performance declined significantly in the past year, moving from an advantage supplier to an uncompetitive provider, and they recently went through a transaction with Ranger. Nine Energy is a discount provider. Renegade's not that big in the pump down market. They're principally more active in cased hole well intervention and servicing type of work. So clearly, in the eyes of the oil and gas operators, there is differentiated value, differentiated performance observed. There's no evidence whatsoever based on the reviews from the oil and gas operators that all wireline perforating service suppliers are performing homogeneously at the exact same level. So you certainly just can't go on price alone in order to get best value and best performance. If you take a look at the key buying behaviors in the North America land market, we find that most users and buyers of perforating services at the operational level tend to be price commodity driven or service driven in their selection of a perforating supplier. Really only a small majority, about 23%, tend to use differentiating technology and performance as a key criteria for supplier selection. And amongst this group, you can see how GR Energy really stands out along with Renegade. Given the importance for many folks to align their perforating operations with the hydraulic fracturing operations to drive efficiency at the surface, what we find is Liberty, who acquired the Schlumberger assets for perforating, Liberty has, as well as hydraulic fracturing, but Liberty is consistently viewed as a top performing hydraulic fracturing service supplier with performance ratings that are better than industry average and clearly positioned as a premium supplier for hydraulic fracturing. But the wireline perforating assets are dilutive to their overall performance profile. It'll be important to track to see if Liberty is successful in libertizing, if you will, the assets of the wireline perforating group and be able to improve performance to the right to align with their hydraulic fracturing business as we go into 2022. Halliburton, the wireline business, has historically underperformed over the last 5 or 6 years, so there's really no surprise on the plotting for the perforating dot for Halliburton. But what is surprising is the hydraulic fracturing competitive performance and positioning for Halliburton has traditionally been in the top right-hand quadrant. And we've recently seen some declines in Halliburton's hydraulic fracturing customer reviews that have kind of slid them into this top left-hand quadrant more recently. I would expect that Halliburton's customer reviews and performance positioning will improve for hydraulic fracturing moving into 2022, and we will again reassess and see if the wireline perforating unit can do the same. But again, really for the last 5 or 6 years, Halliburton's wireline perforating unit has been viewed as underperforming based on feedback customer reviews from the oil and gas operators in the United States land market. NexTier Energy's wireline perforating unit overall is accretive to their frac performance. They just acquired Alamo, who plots in the bottom right, so the Alamo hydraulic fracturing acquisition will be accretive to NexTier's perf performance. However, when you go into the all-important Permian Basin, you can see that NexTier does have some work to do with both frac and perf to kind of improve performance to become better than industry average and move to the right. Halliburton remains the same in the Permian, and then Liberty also has the similar challenges in the Permian that we just previously mentioned for U.S. land more broadly. When we move to the international and offshore markets for wireline perforating, we find that Schlumberger is clearly the market leader in terms of market penetration and market share. We also find that the number of suppliers is much more consolidated, with only 10 wireline suppliers cited as being used on the offshore market and the mid-teens in the international land market. You can see that Halliburton, however, is gaining market share internationally as they seek to grow. And you can see Schlumberger's market share has declined a little bit. When you get to the offshore market, you can see again Schlumberger is the dominant provider, and Halliburton's holding steady at about 20-25% market share, and Baker Hughes' market share declined more recently. When you look at the competitive positioning in the international land market, you can see why Halliburton's gaining market share and Schlumberger's losing market share. Schlumberger's the performance leader, no doubt, and they're the market share leader, but their current pricing strategy is slightly out of alignment with their performance profile, so they're just slightly outside of this fair value fairway, creating opportunities for customer defection and seeking other value-based alternatives, in which case they're coming down here to Halliburton. And Halliburton doesn't perform at the same level of Schlumberger, but they offer a lower price, and so they're viewed as being a more compelling value. Weatherford continues to undervalue themselves, but viewed as performing nearly on par with industry norm, which is an improvement from prior years. When you move into the offshore market, you see that Schlumberger is clearly the dominant provider in terms of size, market share, penetration, and performance. But Halliburton's also viewed as delivering an acceptable value. So pay more, get more, pay less, get less. But the operators see differentiated value in the marketplace, and Baker Hughes' performance declined in the offshore market in 2021 versus 2020. Offshore, you can see that the buyers tend to be a little bit more technology driven than you saw in U.S. land, and service driven. Moving to the tubing conveyed market, which is principally not used in North America land, it's principally used offshore in some of the international land markets. So you can see that wireline perforating prevails in North America land, but tubing conveyed perforating is heavily used in the Gulf of Mexico and internationally. When you look in the international land and offshore markets, you really see a dominance of Schlumberger and Halliburton leading the market in terms of penetration and market share, followed by Weatherford and then Baker Hughes. When you look at the competitive positioning in tubing conveyed perforating, clearly Schlumberger is positioned as the premium-based supplier, but again, the pricing strategies are slightly out of alignment with their performance profiles, setting up the risk of customer defection to Baker Hughes and Halliburton. Weatherford is in their discount position, where they tend to use low price as a key mechanism, and several of the small to mid-tier regionally independent suppliers are positioned as a discount provider. So clearly, the international land operators see differentiated value: pay more, get more, pay less, and receive less. But you can clearly see that most of the suppliers are viewed as delivering an acceptable level of value for the prices charged. Halliburton's undervalued, and Schlumberger is slightly overvalued. When you move into the offshore market, you can see that the market really tightens up in terms of suppliers. Schlumberger and Halliburton have the preponderance of the market, and again, you can see how Halliburton is viewed as the value-based alternative to Schlumberger, who's the premium-based supplier in the tubing conveyed market. So if I were to just do a quick kind of summary of what we see in the perforating market really quick before diving into completion fluids, what we find is that Baker Hughes is considered to be providing generally a good value in the market, both offshore and international land. Overall, for perforating, this combines wireline and TCP together. Halliburton is uncompetitive in North America land, but viewed as delivering acceptable values in the offshore and international market. Halliburton's customer loyalty ratings also trail the industry average and tend to correspond with the fact that they don't provide industry-leading performance. Schlumberger, by contrast, has industry-leading customer loyalty ratings and industry-leading performance in the international and offshore markets. Weatherford continues to be more of a low-price discount provider. They're viewed as delivering a good value for what they provide for the price they charge, but they continue to undervalue themselves, which creates a little bit of challenges, if you will, as it relates to their financials. GR Energy is one of the independent suppliers that's been viewed as a really strong value. Next tier is about industry average. Nine Energy is delivering fair value, and they've moved into the discount quadrant more recently. Pioneer has historically been viewed as a value advantage supplier, but more recently had a slight decline in their performance and competitive positioning. May have been affected by the recent sales and transaction that they went through just recently with Patterson. Allied has traditionally been viewed as a premium-based supplier, but certainly in the fair value zone. And Renegade's traditionally been viewed as a value advantage. Their competitive position declined in 21, but again, Renegade is not really active in pump-down perforating so much as they are in cased hole well intervention work. Perfex is well positioned, recently concluded their transaction with Ranger, and Liberty, who acquired the Schlumberger assets, have some work to do to kind of improve the profile that we talked about earlier. So with that, why don't we dive into the completion fluids? For completion fluids, what we find is that in the Gulf of Mexico, Halliburton is clearly the leader in terms of market share and penetration, but Tetra Technologies also has a very impressive penetration of the market, with about 38% of the operators with whom we interviewed citing use of Tetra Technologies. Tetra Technologies can also be a sub-vendor on some of the components to some of the other providers, so their actual presence in the Gulf may actually be a little bit higher than cited. On a worldwide basis, the completion fluids market is a bit fragmented, with 45 suppliers cited in 2017, but consolidating down to 24 suppliers in 2021. So we are seeing some consolidation in the completion fluids market, which is much needed, of course, but still there's quite a few suppliers. Not so many in the Gulf of Mexico. Most of these suppliers are located in the international markets and not so much the Gulf of Mexico. Gulf of Mexico is principally served by about 5 different suppliers in the Gulf of Mexico, including New Park Resources, which is a newer entrant into the completion fluids market. So in the Gulf of Mexico, you can see Tetra Technologies' market share increasing, Halliburton having a very consistent and dominant share of close to 50% of the market. Schlumberger has been de-emphasizing their presence in the Gulf of Mexico, and you can see that with their market share decline. When you look at overall performance in the Gulf of Mexico, you can see that Tetra Technologies consistently receives customer review ratings that are higher than industry average. You can also see that the overall industry average ratings have been improving in the Gulf of Mexico, indicating that overall the Gulf of Mexico operators have been seeing some improved overall performance and results from their suppliers. Baker Hughes tends to underperform, even though they're improving and most recently in many of these categories. But Tetra Technologies continues to kind of be the performance leader, even though Halliburton, who's the market share leader, tends to perform more or less on par with industry norm. When you look at the customer loyalty ratings as measured by the Net Promoter Score in the Gulf of Mexico, you see that Tetra Technologies' customer loyalty is about twice as high as the industry average rating for the last 4 years. Looking in the Gulf of Mexico, what we find is that Tetra Technologies and Halliburton are both positioned as delivering acceptable values. Tetra Technologies tends to have the more viewed as the top performer in the Gulf of Mexico, even though Halliburton is the market share leader. You would think these two dots would be reversed. Halliburton has adjusted their pricing strategy from prior years to get back into the fair value fairway in the Gulf of Mexico. Baker Hughes is close to the fair value, And Schlumberger, as we mentioned earlier, is kind of de-emphasizing their presence in the Gulf of Mexico and tends to be the least competitive of these four major suppliers in the region. When you move to the international market, you see that Halliburton and Schlumberger share almost very similar market share positions in the international land market. And in the offshore market, Schlumberger is edging out Halliburton for market share leadership. In the international land market, the international land operators clearly see differentiated value, pay more, get more, pay less, get less with the small to mid-tier suppliers, but everyone is very solidly, including Baker Hughes, viewed as delivering an acceptable value. And so that's a really nice profile in the international land market. You see in the international offshore market, Halliburton and Baker Hughes are set up positioned as value-based, lower-cost alternatives to Schlumberger. Schlumberger is exposing some risk to customer defection, but generally well and solidly positioned into the marketplace. We do see differences in buying behaviors. In the Gulf of Mexico, it tends to be more service-driven in the selection and recommendation of a completion fluids service supplier. International land market tends to be a little bit more price commodity-driven, and the offshore market tends to be a little bit more performance technology-driven. So in summary, what we do find is that based on customer reviews from the oil and gas operators around the world, that while there are variances in the performance of the various suppliers, in many cases, there are several good suppliers that are viewed as delivering really strong and acceptable values, some that need to kind of work on their value propositions. Looking ahead into 2022, what we find is that the oil and gas operators are continuing to exhibit some capital discipline. Even though the price signals from the market with the oil prices in the current elevated range, we're not seeing a whole lot of operators really stepping up, particularly those that are publicly traded. They kind of changed their CapEx plans for the balance of 2021. But we do see spending and CapEx plans increasing 10 to 15% in 2022. And as long as oil prices remain stable and elevated, they'll probably continue to climb in those low single digits, 10 to 15% into 23 and to 24. Coming up in the future for Kimberlite, like I mentioned, we had the artificial lift and production chemicals reports most recently published, and we'll host a webinar in November for the oil and gas operators to share the findings of those reports. And then at the end of the year, we'll have updates on cementing services, surface wellheads, and liner hangers, as well as updated projections for 2022. I would like to encourage any of the oil and gas operators, if you have any questions about, how we conduct our analytics and how we benchmark the various suppliers based on your gift of customer reviews, I'll be glad to visit with you on that. And for any suppliers that are on the call, feel free to reach out as well if you have questions. I'd like to thank you for your time today. I'd like to thank the industry for your gift of feedback and allowing us to benchmark the suppliers and to be able to provide this service to the industry. Thank you very much for attending. Bye now.